Listen to me carefully, because what I am about to tell you could save you tens of thousands, if not hundreds of thousands, of dollars in your golden years. So many of you are working so hard, saving every single dollar you can into your 401(k)s and IRAs, thinking, Susie, I've got $1 million saved. I'm rich, I'm ready to retire, I'm safe. And then you hit 62, 65, or 70, you start withdrawing your money, and bam! Uncle Sam comes along and takes a massive bite right out of your hard-earned nest egg. Why does this happen? Because nobody taught you the truth about how retirement income is actually taxed. You thought taxes were behind you once you stopped working, but the taxman doesn't retire just because you do. In fact, if you don't understand how your different buckets of money are taxed, you could end up paying more in taxes during retirement than you ever did while you were working. I see this fear every single day. People write to me terrified because their monthly budget isn't stretching as far as they calculated. They thought they were going to have $5,000 a month to live on, but after federal income taxes, state income taxes, and Medicare premium surcharges, they're left with barely enough to cover their groceries and power bills. That breaks my heart, because it is entirely preventable if you get smart right now. So let's break down the big question: how is your retirement income actually taxed? First, let's talk about your traditional 401(k)s, 403(b)s, and traditional IRAs. When you put money into these accounts during your working years, you got a nice tax deduction. That felt great back then, didn't it? But listen to me, that money in your traditional account is not all yours. That balance on your statement is a shared bank account between you and the Internal Revenue Service. Every single dollar you pull out of a traditional 401(k) or IRA is taxed as ordinary income. Not capital gains rates, ordinary income tax rates. If you pull out $50,000 to buy a camper or pay off a mortgage, that $50,000 gets stacked right on top of whatever other income you have for the year, potentially pushing you into a much higher tax bracket. And it gets worse if you wait too long. Once you reach age 73, or age 75 depending on when you were born, the government forces you to start taking money out whether you need it or not. These are called required minimum distributions, or RMDs. If you have built up a big pre-tax account, those mandatory withdrawals can act like a tax bomb exploding in your late 70s. Now, what about Social Security? This is the biggest shocker for almost every retiree I speak with. Most people believe Social Security benefits are completely tax-free. Wrong. Up to 85% of your Social Security benefits can be taxed at your regular income tax rate. How does the IRS decide if your Social Security is taxed? They look at something called your combined income, or provisional income. They take your adjusted gross income, add any tax-exempt interest, and then add 50% of your Social Security benefit. If that combined number is over just $25,000 for a single filer, or $32,000 for a married couple filing jointly, up to 50% of your Social Security becomes taxable. If your combined income goes over $34,000 for single or $44,000 for married, up to 85% of your benefits are taxed. Think about those thresholds, people. Those numbers were set back in 1983 and 1993, and they were never indexed for inflation. That means almost every middle-class retiree taking even modest withdrawals from an IRA or 401(k) gets dragged straight into this Social Security tax trap. Then we have pensions and annuities. If you are lucky enough to have a pension, in most cases, every penny of that pension is fully taxable as ordinary income. If you funded an annuity with pre-tax dollars, it's 100% taxable. If you used post-tax dollars, the earnings portion is still taxable. And don't forget about taxable brokerage accounts, where you hold regular stocks, bonds, or mutual funds. When you sell investments held longer than a year, you pay long-term capital gains tax rates, which are usually lower than ordinary income rates. Qualified dividends get favorable treatment too. But interest from savings accounts or CDs? Taxed as ordinary income. Are you feeling overwhelmed? Are you sitting there thinking, Susie, is all my money going to be taken away? Take a deep breath. Stand up straight. You are in control. Because now that you know the rules, you can play the game to win. Here are your actionable takeaways to protect yourself and stand in your financial power. First, embrace the Roth IRA and Roth 401k. Roth accounts are funded with money you've already paid taxes on. Every single dollar in that Roth grows tax-free, and when you withdraw it in retirement, it is 100% tax-free. Even better, Roth withdrawals do not count toward the calculation that makes your Social Security taxable. And Roth IRAs do not have required minimum distributions during your lifetime. Second, look into partial Roth conversions before age 73. If you retire at age 62 or 65 and haven't started taking Social Security or RMDs yet, you are likely in a uniquely low tax bracket. Do not waste those gap years. Slowly move money from your traditional IRA into a Roth IRA. You pay the tax today at a low rate, allowing that money to grow tax-free forever, which shrinks those terrifying future RMDs down to size. Third, practice tax bracket management. Don't pull all your income from just one bucket. Blend your withdrawals. Take some from your traditional pre-tax accounts up to the top of your current tax bracket, take some from long-term capital gains, and take the rest from your Roth. By filling your tax brackets intentionally, you keep your total tax rate as low as humanly possible. Fourth, watch out for state taxes. Federal taxes are only half the battle. Some states tax retirement accounts and pensions heavily, while others exempt Social Security or have no income tax at all. Know your state's rules before you decide where to spend your golden years. Knowledge is power, people, but only when you act on it. Do not let fear keep you frozen. Look at your accounts today, talk to a tax professional, create a withdrawal strategy, and protect what you worked an entire lifetime to build. You can do this, you deserve to be secure, and you are unstoppable.